Hey there, folks. It is Thursday. It is Thursday after Fed Day. We've all had a chance to understand what the Fed has done, what the Fed is talking about for the future, because they had what is called their dot plot, or basically their vision into the future. And we're going to be talking with Mr. Jonathan Twomley, a big player in the syndication multifamily space, which obviously there's cost of capital. We really care about what the Fed does. But Jonathan, what's going on? What you think about what the Fed said? What do you got?
Just not surprised at all that they raised. It's funny, there was so much chatter after the collapse of Silicon Valley Bank and Signature Bank and what's going on with First Republic, and a lot of the real estate types who have become utterly addicted to low interest rates were saying, like, well, now's the time, when the Fed is going to pivot, and if they don't, they're idiots, and all this kind of stuff. And the Fed just went ahead and raised rates, just like you and I had been predicting all along. So I think the Fed had to raise rates because it continues to have to fight inflation, and I also think that the Fed had to raise rates because of its credibility. I mean, if it had not raised rates after the bank collapses, I think, frankly, all hell would have broken loose in the markets. So the Fed raising rates was just, sending a signal that, hey, yeah, these banks collapse, but there's no systemic problem. So, we're going to continue to fight inflation, which is, the job number one. So that's how I read things. Obviously, real estate folks are not happy because the cost of capital continues to go up. I know we'll talk about this a little bit in the next segment, but, that it is what it is, and we're just going to have, it's just, it's math. So we'll just have to adjust it.
Yeah, I think there's a couple of things that are important to me, right? Like you, I saw a long list of people not necessarily begging for a pause, but
Yeah.
clearly when you look at the list of people that were asking for it, they all were AKA addicted to cheap debt.
Yeah.
And, I'm hoping people are starting to see this. I again think that Jerome Powell and the Fed didn't have a choice. They
Yeah.
needed to show us that they can walk and chew gum at the same time.
Yeah.
And I actually liked how Jerome Powell didn't come out and explicitly talk about the banking crisis, other than basically saying, not my problem.
Yeah.
I'm here to help if asked, but not my problem. That's over there with the Treasury, the FDIC, banking regulators. Again, I'm part of the team that can help, but my job is stable prices, and we're not there. Job's not done. Here's a quarter point. So I love that. I do think they opened the door to a pause next meeting, which I think was how you get to the top, right? You don't get to the terminal rate by just stopping. I think you need to hint about it. I'll say right now that I expect the final quarter point raise in May. But I think he clearly said, might in May, and at least put a pause on the table for next meeting.
Well, maybe they're going back to the old, Alan Greenspan model of, like, wanting to keep people guessing, not, this is getting away from the Bernanke, like, Yellen, we're going to tell you exactly what we're going to do, and then we're going to do it thing. So, I don't know which model you prefer. I frankly think it's better for them to forecast what they're saying, to kind of give the markets a chance to adjust to it, rather than keep them in the dark. I never really understood that. But maybe that's, maybe they want to return to that kind of, what is
Yeah,
the oracle of monetary policy going to do next? I mean, keep them guessing.
yeah. I certainly prefer clear communication. That's where I kind of come down. I do think he doesn't know. I think predicting May, when we have 6 weeks between there and the next point, I think is important. One of the things I shared on Twitter and talked about in my daily financial news is effectively what I think is going on in the banking environment with tighter credit, less yes answers. It is effectively a rate increase without a rate increase. And I think there's a lot of debate. I read a report from Apollo Group and actually forwarded it on my Twitter feed that talked about the impact might be as high as 150 basis points, or 1.5%. Powell yesterday said might be a quarter, might be a half. It's too soon to tell. But I think it's very important for people to realize Jerome Powell doesn't have to go as high because of what is going on in the banking crisis. I think that's interesting.
What do you make though of the fact that, I mean, I've seen a lot of people online in the last couple of days posting about the fact that that mortgage rates have actually come down recently, right? And, you know, the spread, the interest rate, the nominal interest rates have gone up, but that means that the spreads have come down, right? So, you know, a lot of people were, especially the broker types, were out there saying, you know, now's the time to buy because the you know, the mortgage rates are down. We don't know how long they're going to stay down, so move quickly. And you know, it seems to me like what's going on is that the system is starting to internalize these higher rates, and they're seeing them as less of a source of volatility than they were before, right? Because the spreads reflect volatility, and you know what the banks perceive the volatility to be. And if they're saying like, hey, that, you know, the market is moving forward despite rate hikes, the economy is not tanking, we're less worried about it, the spreads are coming down, and that's having an amelioration of interest rates. So I don't know, what do you make of that? I'm curious.
I actually think it's kind of structural. I think what's going on when you talk about housing market, so we'll do single family and multifamily. I think there is one oddity that very few people understand today in the residential space. And that is quite simply that Fannie Mae and Freddie Mac are still in conservatorship. They have basically an unlimited appetite for first-time homebuyer mortgages. So what is going to benefit from rates coming down? It is going to be that person, the first-time homebuyer. The rest of us, investors, whether I'm an investor buying a cash flow property, a fourplex, or an apartment building, we are going to another entity, another bank, a hedge fund. These things get packaged up and sold most of the time. Their risk profile has changed. And we're seeing most of the market have to pay more, you and I included. Investors pay more, where the home buyer is getting a benefit. So I think a lot of people are confused. Oh my God, the 30-year mortgage rate's going down. Why is it my investor loan? Like, I got quoted 7.5%. Sorry, you're an investor. You're going to put more down. Lending criteria tighter, rates higher. And again, banks are going to make the spread on investors. So I think that's actually what's going on is home buyers, owner-occs, are uniquely benefiting from the fact that Fannie and Freddie are frankly government owned, which is pretty odd.
Yeah, but also, and maybe too, that, you know, the what those banks are looking at is the fact that people's incomes are continuing to rise, right? And home values, you know, if they're looking at like, okay, compared to last year, home values have come down. But if they're looking at from 30 years forward from this moment, right, they're looking at probably the normal appreciation.
30-year fixed rate debt is a great magic elixir.
Yeah. So they're not concerned about long-term of these properties, right? So, and especially at the entry level, right, for first-time home buyers, there's such a shortage of that product type that you see. I mean, I follow some even though I don't invest in this stuff, I follow some markets, you know, just because, like, I follow markets in upstate New York just because I'm curious what's going on. And I'm always surprised by the fact that houses that have a 1 or a 2 in front of the number are sold very quickly, even though this is not a very, you know, it's not growing very fast here or anything. Those houses just do not last.
Yeah. The entry level home, and you know, as a real estate guy who interacts with people every day, the entry level home, which I'll define as 75% of the area median average, is scarce. They're flying out. We have multiple offers, we have bidding wars, and we have offer review dates for that quality or that unit, that thing. They're rare, and it's not going to get any better because builders aren't building that stuff. Yeah. So that inventory is scarce. We've already broken housing, so the move-up buyer is dead. They're not going to sell this to buy that because the payment's different. It is really hard to be a first-time home buyer today. Yeah. It's just, I don't know what to tell them. It's hard.
I'm seeing this in Brooklyn too, actually, where obviously the point of entry is much higher. But in spite of the rise in interest rates, we keep on seeing new records getting set for, like, for instance, in our building. Every time there's a sale of a co-op in our building, it's a new record. And
Yeah.
flipping
We
it
have taken the supply demand curve, which for housing worked for 10 years because of life events, right? People stay for 4 to 8 years, and we've destroyed it. People are going to stay longer. People are going to keep them. They're going to turn them into cash flow rentals. I was lucky enough to be a part of a Fortune article about 10 days ago where we talked about this exact thing. It's we are going to feel the first time home buyer, unfortunately, is going to feel this for years to come, because if you were lucky enough to buy one, you're going to hold on. Most people will hold on. So it's tough.
Yeah.
Going back to the Fed, what did you make of their basically clearly saying no cuts this year? The bond market is saying, we don't believe you. We have 100 basis coming. What do you think?
I mean, I just continue to be surprised at the bond market and the Fed, like the bond market doing the opposite of what the Fed says it's going to do, right? And you know, I don't know whether it's because of wishful thinking or because they're really convinced that this is going to cause a recession, or what have you. But I continue to be amazed that uh, the Powell says no cuts, and the bond market says, oh, they're going
We
to
don't
be
believe
cut.
you.
Yeah.
Yeah,
And it's
you're
just like,
lying.
yeah, and the real estate investors are saying there's going to be a cut, right? And I see people, including good friends of mine whose opinions I respect a lot, posting the stuff about, oh, the average time between the first rate increase and the first rate cut is how many months, and like,
There's
here
a
we are.
lot of wishful thinking going on, I
Yeah,
think.
I don't think the problem is that there's really only they keep on trotting out that data. But the problem is there's really only one example that we have of the Fed raising rates because of inflation, right? To specifically fight inflation.
Exactly.
That's the 1970s. Everything else was the Fed, raising rates because the economy was getting overheated, and like they raised rates because of the dot-com bubble, and because of the housing bubble, and
Yeah.
trying to get a handle on that, not because of inflation. And then, of course, like once they popped the bubble, then they caused bigger problems, and they had to start cutting rates again to get the economy back moving. But they didn't. It wasn't like the 70s where it lasted longer, when they were really having to fight inflation, and it was worse than today. So I think they're just going to continue to stay the course, and at best they're going to pause. And the other thing too is that, as you and I have talked about so many times before, I think it has been on the Fed's agenda for quite some time to get interest rates back to normal, right? And that's part of this. Inflation has given them that cover. They tried to do it. They left rates too low for too long, and then they tried to raise them in 2018, and the repo crisis happened, and then they backed off, and then here they are with inflation, and it kind of gives them the cover to go back and do what they planned. So I don't see them really cutting rates anytime soon, unless we really have like a real recession, and not like some minor little. I think a minor recession, a little kind of pause in the business cycle, they'll stop raising. But I just don't see them cutting. And if they cut, it's going to be just some like minor little throwaway, like, yeah, we'll give you 25 basis points, and see how it goes. And if inflation raises its ugly head again, they'll just be like, hey, we're going to raise some more. So
Yeah. I think at the end of the day, what we all should hope for is, frankly, getting the terminal rate staying there for a long time. And I'll say a long time's a year, just so we can work out this stuff. Again, go back to the list of people begging for a cut. There's a reason they want the cut. Their business model, their framework, they need it. They're going to go broke. And there should be a lot of people going broke.
yeah,
They got addicted. It should happen.
cheap money has kept a lot of zombies afloat, right? And
There you go.
obviously
Facts.
we have. I mean, there's always a tension there. We don't want like these zombies going under and causing a lot of unemployment. On the other hand, like
No,
they shouldn't.
I want zombies to go under.
Well, I'm saying it's a mixed effect, right? So
Yeah.
that we don't.
One
Yeah,
leads to two. Yes, correct.
you don't want to cause the unemployment problem, but on the other hand, Like there's a lot of companies out there that wouldn't exist but for all this cheap debt. And that is not really healthy, right? It's not, you want to have a, it's kind of, it reminds me of like real estate deals that get done because of taxes, right? Like people are selling taxes as the reason to do a deal, like, oh, depreciation, oh, bonus depreciation. I mean, bonus depreciation, my God, this is getting a little bit off tangent, but this is something that has really distorted the market a lot. And just, the government should just stay out of the business of like giving people big tax breaks for real estate, because it just makes the market even worse than it is, already.
I mean, I'll go down this tangent with you. A lot of the pitches that I got for being part of syndications in 2022 and 2021, which would again bonus depreciation, they were basically telling me, and I kid you not, for every $100,000 you invest with us, we'll send you a K1 or whatever the hell the thing is, with $87,000 savings on your taxes. Come invest with us. I'm like, are you freaking kidding me? That's how you're selling me this thing? What are you thinking?
Yeah, I mean, I saw a lot of that too, and frankly, one of the things that was not really being said in those pitches was, well, most people can actually take advantage of this tax break.
Yeah, exactly.
They're not a real estate professional, and you don't get to, if you have a lot of other investments out there that, you can offset it against those. But the problem is most people who got into investing as LPs in syndications over the last 5 years, they haven't run out of depreciation on their other investments.
On the other stuff, yeah.
So they're not making any, they're not making any taxable income on these investments. So this bonus depreciation business really was not helping them. And yeah, I was not a fan. I've never been a fan of tax-driven real estate investing. I think that you're playing a dangerous game there, and it's just the same thing. Like when you're making money because interest rates are low, or when you're making an investment in order to do tax manipulation, right? It means that the underlying investment doesn't have to be good. And then
let me tell you this: if you lead with that, that's not a good sign. If that's the reason you're crazy.
But this is marketing. This is actually, they're responding to the market, right? This stuff works. Like people have this.
Of course it works.
Yeah, people, hate paying taxes, right? And it's a very effective thing to market. But it's, like a good friend of mine, Ted Lanzaro, who's a CPA, always talks about people have this problem where they're like eager to trade dollars for quarters all the time, right? And you don't make.
Why would you do that?
For quarters,
Yeah.
So stop worrying about the taxes and just worry about whether the investment is good or not,
Yeah. So at the end of the day, I think the Fed meeting was exactly what I had hoped for. Kind of, here's a quarter point. We're almost, what I really took for it, here's a rate increase. We're almost done. There's some stuff going on in banking that we have to watch. That's kind of where we were. And I thought that was okay.
Yeah. And also, I did want to mention, I don't know if you caught this because I think it might have just happened. The Bank of England just
raised a quarter point. Yeah.
Yeah. They raised a quarter
just
point.
Happened.
So I think that this is clearly, the Bank of England is not spooked by the impending collapse of the US banking system. They're more worried about inflation. They had a surprise.
Yeah, it just came in at 10.4. It went up.
Yeah. So
it broke trend.
Yeah. Well, they're having, they shot themselves in the foot with Brexit. In England now because of it. When I was there a couple of weeks ago, the big news was that you can't buy vegetables in supermarkets in England because, that all the supply is cut off now because, the Brexit, right? So they can't get vegetables from Spain where they used to get them from. And now, so.
Too bad. All right. Well, that's kind of a wrap on Fed Day. If you have any questions about Fed Day, you want to ask Jonathan or I, leave comments below. Like, subscribe, comment, become part of the channel. We bring you new stuff every day. Jonathan, where can people find you?
Yes, please swing by apartmentinvestorsclub.com, where there's a free download for you about how to do syndication deals. And also join my Facebook group, Apartment Investors Club. We're doing a lot of fun stuff in there, interviewing experts and doing Q&As and just having a good time talking about multifamily investing and a little bit of hotel investing too.
There you go. Do me a favor, folks. If you join the Facebook group, let them know you came from one rental at a time. It's always fun to see that people who come on the channel see their following grow. So one more time, what's the Facebook group?
Apartment Investors Club.
Awesome. Thanks, buddy.